Hello and welcome to today's BeeBusinessBee vlog. And today I thought I'd look at the topic of the economic cycle because it's one of the questions I get asked quite a lot. And I thought to do that I'd use my trusty board to also give you a demonstration. So I thought we'd start over here. So you can see here I have got somebody who is a happy person. And a happy person is going to be likely to spend money, and they're also going to be likely to not have much in savings because they've got no incentive to save, because they're going to be spending money, because the opposite of spending is saving. And of course, when they're spending money, we can find that that's good for business. And it's a great thing for business. Businesses love it because we're spending money. But of course, that means that businesses then can start to increase their prices. And when they start to increase their prices, they create that magical word called inflation. Ooh, scary word that one is. And of course, there's a government target of 2% the Bank of England has to try and work towards. So 2% target of inflation, that's the limit. Any more than that, the Bank of England's in trouble. It starts writing letters to explaining why the target is higher than that. Now, of course, when the Bank of England wants to control inflation because it fears it's getting too high and it wants to limit the spending and make us all feel a little bit more scared and cut back and save a bit of money, it starts to increase the interest rate. And you might be thinking, why does that work? Well, dead simple, because interest is what's paid on loans. So if you've got a mortgage or you've got a bank loan, if the interest rate goes up, you're paying more money. That means, let's say, for example, your loan used to cost you 5%, is now going to cost you 10%. That means your loan costs you more, you've got less money to spend. And of course, most people have got mortgages, most people have got credit cards and personal loans. And on the other side of that, you've got savings. Just think of it this way. If you get rewarded for saving money, if the interest rate goes up, you're going to be more likely to put your money in the bank and save. So rather than getting the current 2% measly figure you're getting now, you might be getting 5%. And if you're getting 5%, you might think, you know what? I'll put my money in the bank for a rainy day. So of course, the Bank of England knows that can start to make people start to save. So you can see down here, I put my increased costs of borrowing, reward saving, and it slows down the economy. And of course, that makes some people start to feel sad because they've got bills to pay and they've got to mortgages, for example, and credit card loans. And that is how the economic cycle works. So when you think about the economy, just think it's a cycle like this. And I know that's quick and it's one of my little vlogs, but I've taken you around the whole cycle of how it can impact. I actually have got BeeBusinessBee videos that go into more detail on this. But remember, until next time, keep buzzing.